So, short term, who knows? We're all looking for a bottom in everything short term. But long term, I feel like we're still not over the hangover from the party that ended in 2006. Structurally, we're still short of housing. We have low inventories. We have increasing demand, from younger generations that want to buy homes, and they're not there, So, sure, mortgage rates have soared in record time. I get it, right? Pricing has to come down to balance that out. I get it, I do. But longer term, people got to live someplace, and we know historically, I forget who it was that was telling the story about. I think it was Scott Galloway. He was telling a story about how, hey, look, honey, mortgage rates got below 10%. Let's buy a house. When you go from whatever it was, 2 something, below 3, basically, to 7, it sounds really bad, and it is. It does damage. We all acknowledge that. But, historically, are we really that bad off? I mean, I don't know. There's always, Peter Cundill, the greatest quote by Peter Cundill was, there's always something to buy. And it's true. I mean, sometimes you really got to look hard, but there is always something to buy. We were in, it went up, and then, it started rolling over and we were out because I thought, well, a store of value in a currency doesn't go 5x and then get cut in half. And I was like, I got this one wrong maybe, for now. Over time, I just want it to work. And in the short term, we hit that June 16th bottom, and bonds and stocks have violated that bottom, but Bitcoin is not. And we've seen these articles about the volatility coming down. And I keep making long picks. People don't realize this. It really is true. I really don't want you to sell great stocks, and I really do want you to hold cash and gold and silver and stuff. And I think these 10 stocks that we have in this are going to do well, no matter what interest rates are, up or down. I think they're going to do well. If we get a sideways market for 20 years, like we saw, after the 29 thing and after the dotcom, when the Nasdaq went sideways for 15 years. So if on balance, my bearish fears come true, I think these businesses are going to do great. And there's gold and silver and gold and silver related equities in there. There's renewable energy in there, and there's insurance, which is, I think, a wonderful inflation play. Or not. Insurance is going to do great, but as an inflation play, the asset values go up, the premiums go up. It's great. So there's a lot of stuff in there that you actually might not expect to sort of protect you in inflation, And to me, it's like inflation or not, I just want to be prepared. I make these predictions, but people don't understand. The predictions aren't the words. The predictions are when the rubber meets the road and you allocate the capital. That's your prediction. Yeah. Okay, so I talk about all this stuff that I think is going to happen, but I hope people hear me say, I don't know if I'm right or not, but when the rubber meets the road, I'm still making long picks. And yes, I'm telling people to hold lots of cash. Yes, I'm telling them to hold gold and silver, but I'd probably say hold gold and silver anyway, and make sure you have some cash if we find a great bargain. So I'm just sort of turned the volume up on a couple of the pieces. Well, it's been a great store of value for not just 5,000 years, but hundreds of years, and in the last several decades, and in the last couple of decades. It's proven itself over, every reasonable time frame, in my view. You're right, we're not going to live for 5,000 years. So what it does over 5,000 years, but the point there is not, you can make fun of that if I'm saying gold's been in a bull market for 5,000 years. That's why that would be silly. Yeah. But I'm not saying that. I'm saying for 5,000 years, it's been a great store of value. And it's not, somebody used the word investment about it. No, it's not an investment. Not at all. It's not you buy a bond or a stock, and the hope is that that thing is going to generate, let's stick with just stocks, that thing's going to generate excess cash profit, which is then going to create a return for shareholders, right? That's what you want. That's an investment, okay? There's a return there. The fact that people criticize gold, Buffett does this too, you dig it out of the ground and it just sits there. That's its job. That's why it works doing what it does. I mean, we used gold from the end of the Napoleonic Wars until World War I for a reason. That was the century of deflation for a reason. It worked. The only reason we stopped doing it is because they wanted to print money to fight the wars, right? So we might still be doing it if they didn't want to fight World War I. And since 1971, it's a 50-bagger. This century, it's beat stocks. So if you insist on calling it an investment, but every time I say that, it's beat stocks this century, I have to step back. You just said it's not an investment, and it's not. I mean, if you can get a really good royalty or a really well-written streaming agreement on, say like a copper mine. We have one of those in Extreme Value. That's an awesome investment. They will, if the people buying that streaming agreement and choosing the mine on which to do it are really good geos, really good, with the geology and understand the asset and understand the deposit, you're gonna just have cash flow for a very long time. And if you pay the right price, they're great investments. And I'd rather not do it with gold. Your gold these days, you're gonna, I don't know exactly what you're gonna find maybe in size, but you're gonna mine it for a decade or something. But a good copper mine, you could be decades, several decades, or we have some potash royalties in the portfolio. Those resources are literally like hundreds and hundreds of years, over 1,000 years in one case. I mean, there are royalties on Canadian potash, and one of the other places where they do a lot of potash is like over where they're fighting a war right now. So it's real good to have a royalty on Canadian potash, which is like 20% of the supply. I would say this is a good chance for me to say that I love prospect generation and I love royalties. I don't love mining so much. That's a difficult, crazy, capital-intensive business, highly cyclical, really difficult. The royalty on the mine takes something off the top. They get paid first, right? So as long as they're still mining, prices can kind of go all over the place. And sure, your cash flow stream will vary, but you'll always get paid. The mine shareholders, they're not going to get paid nearly as often as they want to. And then on the other end of it, prospect generation is you throw a little bit of money at a whole bunch of mining prospects, then you partner up with somebody to spend a lot more money to drill them out, and most of them don't do anything, and then every now and then one of them hits, and you've spent $2 million and got something worth $200 million. Like prospect generation is like the VC of mining, right? So we were talking about Andreessen Horowitz this morning. They made this. Their biggest bet ever was $350 million. Yeah, but AUM is 35, so they could have 100 of those, right? And they don't care about any one of them. I like those deals. So, big picture is, I believe, and I say believe because I can't say it's a fact, and I've emphasized this all along, but I am very bearish because I believe we just lived through like the biggest financial mega bubble in all recorded history. The bond market peaked in 2020. The 10-year was actually below 40 bips, 0.4% yield in March 2020. And then later that year, we saw the negative yielding debt in the world, like, Japanese and European sovereign debt was the negative yielding portion of that was like $18 trillion. When it's negative yielding, you are buying a bond that after you get your principal and all your interest payments back, you have gotten back less than what you bought it for. So, that was like the 2020 was what I'm calling the biggest, really, asset bubble in all recorded history. We do have, Sidney Homer's got interest rate data back to 3000 BC Mesopotamia. And, you fill in all that, interest rates were never as low as they were in 2020, meaning bond prices were never as high. So then we get around to 2021, and I just see the classic, market peaking cycle. All the garbage peaks first in the first quarter of 2021, the cannabis, the SPACs, the garbage-ear tech, that you don't want to have. And there was another, cannabis, SPACs, garbage, clean energy, in there. And then later on the year, Bitcoin peaked October. Small caps peaked like November 8th, 2021. 11 days later, the NASDAQ peaks. So you ran right up the quality trail there, right? Garbage, Bitcoin, small caps, NASDAQ.
Yeah.
And then at the top of the quality trail is S&P 500, and that peaked in, just called January 2022. So from this vantage point, I can look back up at that, and it looks like the peak of this giant financial mega bubble. Problem with trying to figure out what comes next is you can't do it because there's no data. Like if you're trying to average across bear markets, I think you can't do it because this is different. The only other data points are like 1929, which, if you told me, what does that have to do with today? I couldn't argue with you, right? What does it have to do with today? I think it's just, the data point there is just human behavior.
Yep.
It has nothing to do with the businesses that were happening at that time and the economy and the structure of markets. It just means humans can behave like this, and they behaved in 1929, they behaved that way in March of 2000, they behaved that way December 1989 in Japan. And that market's still going sideways. 33 years, still hasn't gotten back to the top in 1989. So, whoa, that's a little scary.